If you're self-employed and you haven't heard about the solo 401k, boy, are you missing out. You got to stay in and listen to this video because it is one of the most powerful, not only retirement strategies, but for tax savings as well. Hey guys, before we dive in, quick intro. My name is Andrew D'Amico. I'm a CPA partner here at Ledgerly alongside Mike Abrahamian, also a CPA, where we operate Ledgerly, where we're constantly helping business owners save taxes, improve asset protection, and focus on building generational wealth. So if that any one of those three things is part of your mission, what you're after, please do yourself a favor, subscribe to this channel. Now, diving straight into our topic and the whiteboard. So I introduced solo 401k. Before I talk about this trifecta, what is a solo 401k? Imagine many of you have probably held a job before, maybe even right now, and after you get hired or during the onboarding process, they're like, hey, yeah, and if you stay at least a year, you can participate in our 401k where we do a 3% match. Ooh, how cool are we? Yeah, okay. 3%, we want better than that. And that's why we're talking about the solo. But it essentially functions the same way. It is for retirement. And specifically, the solo is for that self-employed business owner. And the reason we like it, if we can get to this, and why we like it more than that group plan that you have at work, at your day job, is because it's like a 401k on steroids. And you, the solopreneur, are the ultimate beneficiary. But there's a few caveats and rules in order to be eligible to operate or open up a solo 401k. So if you go to my whiteboard, we have a trifecta up here. If you're not familiar, and maybe you haven't seen some of our other videos, go check those out. But high level, quick breakdown is the left side is our ordinary income that's going to be subject to FICA taxes. Think day-to-day operations, like the equivalent of a 9 to 5. Whereas on the right side, that's representing passive income. So you can see there's a few 401ks up there, property in an LLC, maybe you have rentals, and then any other investments, like maybe you have a brokerage at a Fidelity or you own cryptocurrency that you buy and sell. That's all passive. You need ordinary income in order to fund a 401k. So really, this W-2, if you have it in your picture, that's going to be what allows you to participate in that work, that group 401k. And then I put here side hustle because you don't need to have your own business per se in order to open up a solo. This could be from, like I said, side hustle income. You're an electrician, you do some jobs on the weekend, you report it on your tax return, that's ordinary income. Or you drive Uber on the side, you get a 1099 from them every year. You could use Uber income to fund a solo 401k. Or maybe you could actually be operating your own full-fledged business, maybe as an LLC, reporting on Schedule C, or maybe in an S corporation. Any ordinary income on this left side that might fall into this side hustle bucket will provide you with eligibility, potentially, to open up and adopt a solo 401k. So that's one of the, maybe I should write it here, one of the main requirements. Let's get this in a different color. So one, we know we need to have ordinary income. And then number two, I have not said yet, but we cannot have employees. When it says solo in the title, it's not just saying, hey, you're in business for yourself. No, it means you are the only employee. And there are specific rules and hour tests tied to that. I don't want to go too deep on that right now, but essentially, if you have a full-time employee, or somebody works for you over 1,000 hours in a given year, that means they are considered full-time by the IRS, which would disallow you from participating in a solo 401k. You would have to go over to a group option where there aren't as many great benefits because you have to offer the same things to anybody else in the plan, like your employees. Now, one of the cool things is employees does not count your spouse or your kids. So this is an incredible family wealth building tool. Yes, it's for you yourself, the business owner, but it extends to the whole family as well. And we talk about that generational wealth. This thing is a home run. Now, regarding the setup process and how you actually implement one for your business is you go to a custodian. You can do it at like a Fidelity or a Vanguard. I actually did mine with KKOS. If you're familiar with Mark J. Kohler, CPA, tax attorney, runs KKOS Lawyers, alongside his partner Matt Sorensen, who runs Directed IRA, which is all about retirement accounts and self-directing retirement accounts. You can connect it and set it up with them. They're lawyers, so they write the plan document for you. You get to have a consultation with an attorney for an hour going over your plan. But regardless of how you set it up, you go to someone, you get some plan documents in place because you're going to need to obtain an actual EIN for that plan for the 401k. So it's not going to be the same EIN as that of your business. And to ensure you get all your contributions in place, you really want to have this plan set up by the end of the year, by 12/31, because ultimately the contributions that are going to be going into this plan need to get reported on your W-2 as the employee, and W-2s need to be issued in January of following year end. So within 30 days. So it's important to get this in place and kind of have an idea, provision for yourself. Where's my income, expenses, what do I have left over? How much can I put away in a 401k? So I think that's enough about logistics for now. So let's get a clean sheet. And now we're going to go over, I've been talking about it enough. What are the actual benefits? You might be asking, which you would be right to ask. So let's get benefits. My marker's dying on me, so we'll stay in blue. Benefits, and you can imagine there's quite a few. And there's actually some on the individual level and on the business level, because this is going to be ordinary income, self-employment income. So you are both the individual and you're the business owner. So first one right off the bat, I was talking before, hey, in like a group plan at work, maybe your employer gives you a 3% match, right? They'll match up to 3% of your compensation. So you have $100,000 W-2, they'll match up to $3,000. Hey, I'll take free money whenever I can. But in a solo 401k, you can match 25% of your W-2 wages. Now, granted, it is capped, but you can see that 22-point increase. It's massive. So if you're really focused on building your retirement savings and you got, I don't want to say money to burn, but you're successful and you can afford to fund your retirement while still living a good life, the life you want, it's very powerful. So we'll say increased retirement contributions, put in here 25% match. And then another piece that's great with this is the flexibility. And there's a few different levels of flexibility in here. One of that being is you can have multiple types of retirement accounts in here. You're probably familiar with the old age conversation of, Roth or traditional. Roth, hey, there's no deduction, but my money is going to come out tax-free. Traditional, you get a tax deduction for contributions on the way in. But you're setting up this plan, and you could also set up 2 other accounts in your plan, those being an after-tax account as well as a rollover account. If you want to bring in old 401k monies or old IRA monies that are sitting around and you want to fund your solo 401k so you could have all this capital in one spot, compounding, investing, and growing on an annual basis, it's very powerful. I'm going to do another video that is kind of a part of a mini series, so I'm not going to go too in depth on account types, but that after-tax piece, that account is going to be a big topic for discussion when it comes to funding as much as I possibly can in specifically Roth dollars. You have a lot of account types you can open up, and this is your plan. So when you talk with the attorney, you can say, hey, I want an after-tax, I want a traditional, and I want a Roth. Or you can just do one, you can do all 4, whatever. So account types, family. I alluded to it before with the employees. And the solo 401k, you can put your spouse on payroll and they could play in the solo 401k without disallowing you that 25% match. Now your spouse gets 25% match as well. Your kids, if you're doing it right, maybe they're on your board of advisors, they're helping you in the business, you're grooming them to maybe one day work with you or take it over, you give them the salary, you can fund a solo 401k for them as well. Again, 25% match. So very powerful. And I mentioned our good friends over at KKOS and Directed IRA. This account can be self-directed for higher returns. Now that's an advanced topic. And I'm not saying if you're going to do a solo 401k, you have to set it up in order to self-direct, but that's just kind of a cherry on top. If you want to use your 401k monies to, hey, I want to go ahead and buy some real estate, or I want to buy some cryptocurrency, or invest in other alternative assets, you're not stuck with those if you were doing this through a Fidelity and you're stuck with stocks, bonds, and mutual funds. So the ability to self-direct, you're not going to get that at an everyday job 401k. You're going to be stuck with investments. In here, there's true freedom to self-direct, so long as you set it up with the right custodian. If you set it up with Fidelity, you're not going to be able to invest it for real estate. And then for our business side, it's primarily you're going to get a tax deduction at a few different levels. The plan setup, consulting with that attorney, or the account fees for maintenance, or maybe any filings that need to be done with it if it's the plan assets are over a certain amount, you get to deduct that. So we'll say set up these, say legal, kind of in the same bucket. And then also the contributions. There's a specific line on tax returns, employee sponsored benefit program. That's where this comes into play. So you get to take a deduction for setting up the plan and for the contributions that you're matching to your employees, which can be as high as 25%. So guys, I hope you found that useful. Hope it made sense. And whet your appetite for another video, because this is kind of just scratching the surface at what's possible. In later videos, we're going to go over, hey, what are even more benefits? How can I actually strategically fund the maximum contribution of $70,000 into here? But we love this strategy for our small business owner clients because, hey, keeping it in the family, we're getting tax savings, tax deduction now while at the same time laying the groundwork for the future. So please leave your comments, questions, like this video, subscribe to the channel, and we'll see you again on the next one.